Good afternoon. This is Jeff Scott, and this is my weekend review. I am doing this at approximately 3:30 on Sunday, March 15th. Happy St. Patrick's Day. Probably going to be an interesting night. Probably a lot less people than normal. Now, I titled today, Dead Cat Bounce Friday, Beware Bull Trap Monday. Again, it's March 15th. My name is Jeffrey Scott. My contact email is hgsidoc@gmail.com. As always, this is for education purposes only. Any recommendations in the spirit of education, not investment advice. I'm a doctor, not a broker. I don't have any licenses that would say it's okay for me to trade for you or to tell me what to trade. I own all the programs that I use, and trading involves risk, and you are solely responsible. I always title my education, Be Your Own Guru, and I highly recommend the books and folks that are listed there. The website for Hgsi, although I have nothing to do with it financially, I do spiritually, under free 30-day trial, you can get access to the program for a month with no credit card. Under investing strategies, you'll see hundreds of videos by myself, Ron Brown, and others. Stock patterns are cyclical. One of the things about growth stocks is they go up like rockets, come down like rocks, and it's very important that you understand where you are in a market cycle. Pretty clear where we are. We're in stage 4, fear. That means you have to be buying differently on the right today than you might be on the left. Now, if you believe this is a V-shaped recovery and it's off to the races, God bless you, then you can ignore the next hour. I'm buying, or I bought up until Friday afternoon. I bear call spreads, which means I sell a call and buy a call further out and collect the premium. I buy puts, I sell calls, I short stock, and I buy contra ETFs. All of those predict the stocks are going down. I'll talk more about what I'm doing as we go along. Now, this is a funny slide considering how bearish I am. All these things in red are futures. If one looks at the S&P sectors, they start with the materials here. Hard to find anything that was down on Friday. We had a ferocious recovery. In fact, I was reading this beforehand from, I think from Lee Tanner. Lee Tanner's with the Palatuma IBD board. He's an excellent trader. Last 26 minutes on the Friday, the NASDAQ rallied 6.1% on 740 million shares. NASDAQ rallied on Thursday mid-session 5.5% in 20 minutes. So the market can go up if it gets the right signal. So put that in the maybe Jeffrey's too bearish camp. We'll give that a point. Major markets tell a story. I'm not going to bother going into think or swim here. I think the picture is obvious. On E-mini futures, NASDAQ futures, and Dow futures, we peaked a couple weeks ago. We went straight down. There was a reversal day Friday. We'll look closer at that in HGSI. On the Russell futures, we never hit new highs, and we dropped much further below the 200-day moving average. The VIX corrected some on Friday, and the dollar is moving back up. On the weekly charts, you can get even a better picture of where we've been and what we've done. And yeah, you could see we stopped right on the 200-day weekly average on the Dow. We're above it on the NASDAQ. We're through it on the Dow. We're really through it on the VIX, on the Russell. The VIX closed midway, big up week on the VIX, and the dollar is meandering its way higher. I like to look at specific things to give me a sense of what the market is doing. It's hard to see, but they actually have doubled up on itself. Both the 10-year and the 30-year rates have risen off of record lows. The AD lines have rolled over with stocks on both the Russell 200, the Russell 1000, and the NYSE. And this week, even in light blue, the TLT rolled over. All the ETFs, Russell, transports, Dow, NASDAQ, bonds, all rolled over this week. If we look at breadth, it's weak, just above 2008 levels. Here's the stocks above the 200-day SMA. This is where we are today. This is where we were in 2008. Other than that, we're the lowest that we have. On the 40, the story's the same. If I look at the 3-month new high, new low, no surprise on Friday we bounced as the market got so oversold. We're still at a place where further bounce is likely or possible. The daily McClellans are setting records on how low the summation index is. We've taken out multi-year lows as well in the oscillator. I wouldn't call that records. I would say it's multi-year lows. And on the weekly, similar. Current buckets, take a look at where we were on Thursday. Thursday night, 99% of the stocks closed below the lower band of the Bollinger Bands. I mean, below the midline of the Bollinger Bands. 80% of stocks were below the bottom. Stocks don't like to live outside their Bollinger Bands. They spend 10% of their time there. If the entire market is below the Bollinger Bands, the market's going to revert to the mean. And that's what we saw on Friday. Still a very oversold market. HINDYs, there won't be any HINDYs until we get new highs. The interesting thing is there's like no new highs on the NASDAQ or NYSE, but there are new lows over 20% on both of them. Market tone, here's how we ended the week with a bunch of kahunas on Friday, which interestingly, although we still finished way down on the days, they were enough to turn the market. We finished way down in the week, up day obviously on Friday, enough to turn the market green. These colors here under the bandwidth just signifies how much volatility we see in the market. For comparison's sake, this is December 26, 2018, when we had a V bottom, a bunch of kahunas, flipped the market to green, and we've had a bull market since. Sector strength also had a bunch of kahunas, flipped, and shows a substantial amount of volatility. The canaries in the coal mine, the extended FANG, dropped 32% in 17 days, bounced on Friday. The index I put together of leaders to give me an early warning signal worked, but they're no longer leaders and I won't be following them anymore. All eyes will be on the Fed Wednesday with a funds announcement and Powell's speech. More to talk about that in a few minutes. And despite the fact that we have enough to deal with coronavirus, the Fed, lack of toilet paper in the grocery stores, we still got a bunch of earnings this week to keep us on our toes. Here are my thoughts. The market staged a massive short covering rally late in the day Friday as the Trump administration stepped up action against COVID-19. House passed legislation to support workers and the Fed increased QE. Yet, major markets ended up the week with substantial losses anywhere from 8.8 to 16.6% down as stocks, gold, and bonds all fell on the week. You can see the NASDAQ minus 12 on the year, S&P 500 minus 16, Dow minus 18, and the Russell's minus 27.5%. Those are pretty bad numbers. Negative corporate news might impact futures. Boeing with new problems with 737s that are in the market, which came out after hours. Microsoft dropped several points after hours, noting that Gates was exiting their board. Apple shuts retail outside of Greater China. I just saw that Amazon has run out of goods because of the selling, the massive purchasing related to COVID-19. What about COVID-19 news itself? The no-fly zone expanded to Ireland and UK, while we're hearing more and more talk about grounding of domestic airlines. From a physician perspective, might not be a bad idea. From an investor perspective, holy schmoly, that could be perceived very poorly. Rapid increase of new cases, shutting down of U.S. departures from cruise ships. Spain and Italy shut down everything except for grocery stores and essential services. And then in the U.S., there's a hit to sentiment when every day you hear about something else being closed, whether sporting events, concerts, trade shows, meetings, etc. And all eyes are on the Fed. We want to hear about additional QE, repo rates, and then is it time for 0% interest rates? How am I playing? And this actually note is to hopefully my son will see this. Smaller number of positions, smaller size of positions, strict money management on new and old positions, shorter time frames, maintaining protective puts on key longs, trying to avoid FOMO. I have to admit that was difficult on Friday afternoon. And my mind is open to playing both ways. I've made a lot of money on contra ETFs and volatility the last 2 weeks, but took a lot of heat on existing positions. I'm sharpening my skills to identify and play a bottom, and I'm getting my box stocks ready. Let's take a look at the markets, and we'll come back to some more slides in a few minutes. Very quickly, if I look into the into the trade station, there's no reason to go through a lot of these because they all look the same. If I look at the E-mini, I can see I am in a daily, weekly, and monthly sell signal. That is the same on all the major index futures. I am in daily, weekly, and monthly bongo bearish, the same on all 3 futures. The high jump doesn't matter here, and we haven't been at it long enough to see any of the green dots forming, which might suggest we're getting evidence of a reversal. I'm not going to go through all 4, but I'm going to shift you to some other tools that I use as well. That's coming. My buddy Cigar from Superior Profit makes some very interesting tools for TradeStation. Much to my shock, after I paid for 15 years worth, he put them out for free for 1 year to Hgsi users, and some people took them up. In my mind, there was a lot of people with a missed opportunity. He has a number of unique indicators. He has plotting of support and resistance. He has short-term resistance support for looking at price moves. He has these indicators in red. That is called, I think that's a headwind. Let me make sure I got him right. He's got headwinds. He's got stretches, different things. When I see the red circles or the pluses or both on top of a stock, I know it's running too far up. It's getting extended. It's going to reverse. When I see the green ones, it's usually a reversal as well. What I want to point out is he called the top of the market on the weekly and on the daily. John Persons called the top the next day, so they both were extremely accurate, neither of which, I don't see a person on the bottom. I'm starting to see some of these headwinds and stretch signals on Q. So it'll be interesting to see, but we still have a market that's falling. Here's some natural support areas on the S&P futures. Now, this is a bullish picture on the end of the day Friday. I'm still concerned that we're in a downtrend, and just as we were bullish here, we ran up into resistance and came down. The other thing I want to point out, and for whatever reason, it's not showing up on this one. Let's see. Go back here. Yeah. You notice these little peaks and valleys. These are from a guy named Roy Kelly, and he looks at major cycles. And when you see the red line, and once these print, they don't move. Once that red line pops in, it defines a major cycle. He called a major cycle top right up here on the weekly, and a major cycle bottom on the daily. So both Cigar and Roy Kelly are suggesting that we might be at a place of a bounce on the dailies. I think it's a very important question. I have a lot of different tools that I use, and that was a pretty impressive day Friday. We'll know more on the futures. It's not what I'm not going to guess. I'm going to look at the data and make a decision in the morning as to what I'm going to do. If I go into HGSI, and I'm looking at this in 4K, so if you have not great resolution on your monitor, I apologize. And if you like these videos, go buy a cheap 4K monitor. And on Amazon, you can buy a $300 portable 4K monitor. So there are ways to get around the monitor thing. Market analysis groups, Major Markets Plus, hit Warehouse View. Here. So when I do in my top-down view, that's the view I like to use. Excellent. Ranked by raw combo, things will come to the top based upon 1-day movement, 5-day movement, and 13-day movement, where the 1-day movement's the most important. And no shocker, the strength on Friday was the dollar, the NASDAQ, the S&P, semis, and the weakness was gold miners, gold, silver, bonds, gasoline, commodities, volatility, and then small stocks were weaker. If I look at 1-day performance, you could see semis were up 10%, S&P were up 10%. Down here, volatility was down 23. What's profound to me is 5-day performance, volatility was up 37, dollar was up 5.5, treasuries were up 4.5, everything else was down over 5 days. Gold miners 35% down, gas 33, oil 20, NASDAQ 17, and so on and so forth. This was a horrible week in the market. If we look at some of the major indexes, we'll start with the S&P 500. And we're going to spend a few minutes looking at this one. So one question needs to be, that's kind of hard to see, so let's go to this one. Are we currently at a bottom, and should we be rolling up the truck? So in the favor of this being a bottom, we had a very bullish candle on Friday. We had a Eureka, which is a follow-through day. That's a bullish signal. We had a Kahuna. Our high jump is coming off the bottom. And we had not quite a hammer, but a big bottoming tail on the weekly chart. So if you want to believe we're at a bottom, and you have what my son has, which is FOMO, be my guest. I'm not ready. Why? I'm not ready because this is like 17 days. And when I go back and I like to look at data, I don't see a 17-day top-to-bottom bear market very often. So I actually asked myself this morning, what have other market pullbacks look like? And how will I know? So, what does a bottom look like? A journey through the last 20 years or so. 1998, we had a gradual run-up in the market to new highs, and the market rolled over, spinning top. We had a bottom, but there wasn't the bottom. We had a run-up and a failure at the 200, and then we had a bottom that took out the prior low, and that was the bottom, and we subsequently gained 67.6%. Let me show you a few things on this slide. We had a Kahuna preceding the rollover. Excuse me. We had a Kahuna to the downside. We had a Hindenburg omen signal. Sorry, Ian. He's probably rolling over when I said that. We had several bingos, which are baby out with the bathwater. We had a decisive break below the 200-day moving average. We had a reversal day that looked a lot like Friday. After this day, we had a few-day pullback, not taking out the lows of that day, and we took off in a move up and failed at the 200-day moving average. At which point we pulled back again, tested successfully the lows, we're off to the races. we had a Eureka, we had Kahunas, we had a low jump bar, all occurring at the bottom. We had it here as well. Now, you would not have been that hurt had you taken this call, but you would have hopefully had stops and prevented damage here. This is a W bottom. That's more of what we're likely to see. 2002. Market pullback here. Looked like it was done. Big reversal day like Friday. Market ran up, failed at the 50, came back, retested, set another low, lower low, and took off. Again, Eurekas, Kahunas, John Person buy signals. W. Now, I'd also like to point out failure here at a moving average. And had you gone long, as long as you were prepared to get out again, you could have made some money. 2009, multi-year down, not multi-year, but big year down, culminating in a low. You had 2 doji bars, a reversal candle here. You had was this what we thought was a low? Maybe this is the low. Nope, this is the low. So a complex bottom formed. Subsequent gain 101.6%. We had the bingos. We had the Eurekas. Ultimately had a Kahuna. And you know what? You don't have to rush. Now we knew, we came out and said that this was a reversal here. Could have bought that day. Could have waited till it broke above the 50. Could have waited till it broke above the 200. All these were good opportunities. And there was no rush. That's for my son. No rush. 2011. We had a new big pullback. That looks like a reversal, a big hammer. Just like this. Doesn't that look like Friday? Went sideways, went up, but ultimately failed in a lower low. We went up 93% from this low. Again, Eurekas, Kahunas. You could have bought there, but you could have been shaken out before you hit. And you just want to make sure you protect your capital and you have money left. 2016. This is a very complex low. Reversal day like Friday, that failed. Another reversal day, got up to the 200-day and ultimately failed and came back here. So we were down 15.5% and we subsequently gained 58%. Again, Eurekas and Kahunas. 2018, this is the one that's a true V bottom. We dropped 20%. On December 26th, we had a day that looked like Friday. Just the day before looked a little bit less impressive to the downside. We had our person indicator, Eureka, our Kahuna. The market took off. Did you have to buy the first day? No. You could have bought any of these days in here. You could have bought above the 50. You could have bought above the 200. Any of those days, you would have made money. There is plenty of time. So, are we at a bottom? I don't know. If I knew, I'd be a liar and a cheater and a thief. We might be at a bottom. Do we have a little bit more move left before we go back down and retest? That would probably be possible. Or are the bad news that's building up going to take us down? It would not surprise me for us to get a move up and then a retest before we go on to new highs. This is not a financial crisis where the Fed can fix us with rate cuts. It's not a financial crisis, in my opinion, where we can fix the problem with a payroll cut. It'll probably help the market. It'll probably make me feel pretty good. But at the same time, we got to deal with a viral infection that's going to potentially decimate, a lot of families and have a lot of costs. Pack our hospitals, force people to be denied care, ration care, and could lead to the closure of a lot of services. Is that the feeling you have that a market's going to go back up? I don't. So, back to the markets themselves. I thought it was important that we looked at prior markets, so that if we think that this is what a bull market looks like or a bear market looks like, we had good comparators. So very quickly, because they all look lousy, that's the S&P, the Dow Jones Industrial, similar Eurekas and Phoenixes. Glad to see them. Glad to see them. The NASDAQ, similar pattern. The Russell just started from a lesser position, has rolled over hard. Yeah, it looks like a reversal candle there, but for how long? The dollar has been stronger. Flight to safety, you can see the dollar has moved up quite a bit. The volatility has been crazy high. It reversed on Friday, so is that the time to buy? It might be. But again, beware double bottoms, beware bear bull traps. Gold has been a dog. You can see gold is pulling back towards its 200. And where gold has been short-term ugly, gold miners have just been dead. And silver looks a lot like gold miners. We saw historic falls in oil this week after the Middle East, friends in OPEC and Russia could not come to an agreement. Big gap open on Monday certainly stimulated a big market sell-off. This is not a healthy market. It could be the beginning of the end of the pullback, and maybe we're starting a new bull market. I have my doubts. I think this market's predicting a recession, that this is the first leg down in a bear. I think we are likely to see a move up before we go much lower, but I think that this is not a 2018 market. I think it's one of the ones I showed you where the market goes further lower after the initial onslaught. If I looked at industry groups, look at two-day force, I had a number of people ask how come they don't see my 2/16/2020 Scott webinar views. The reason is simple. I just took my regular views and I added person's indicators to it. If you don't own the person indicator package, it's the same as my regular views. I added numbers of new buys, new sells. Look at the entire index buys and sells. And I guess the point I want to look here is these are two-day force, the strongest groups. Look at the number of buys after Friday in each list. Very, very few. So we're going to find as we look through this, and we'll look through the first couple to prove my point, that you've got a bunch of beat-up stocks that have high volume and up days on Fridays and made it to this list. I don't see a market with a lot of things that look really good to buy. I do like the first two stocks I'm going to show you, but they're both indicative of the market. Here is Intel. Clearly was a leader. It died here. It came back down quite a bit. In fact, we wanted to look at Intel. One of the things I like about Hgsi is I can open up that, and I can go to where the top was here and go to where the bottom was. I don't know where the bottom was. It's hard to tell. It just says it's here. We were down 22%. Excuse me. 33% down in 21 days. 22 points. That's a pretty awful move. We had a big bounce on Friday. We took out the 200-day SMA. You have a person buy signal. Here's the Eureka in the markets. Here's the kahuna. If you believe the market's going higher, I expect Intel to be one of the leaders. If you believe the market's going higher. AMD did not fall nearly as hard as Intel. It's bouncing. I have a position in that for full disclosure. NVIDIA looks like AMD. Qualcomm, much further down the pattern. No reason to keep going because they get worse. Banks, regional banks made the list. Now you're going to look at them and they all look kind of a lot like Qualcomm. Big pullbacks and a bounce. Why do they make it to the list? Because the list looks at price move times volume. 20 million shares, $5 price move. big move on the U.S. banks. Now I could show you 20 of them. They all look very similar. Dead cat bounces, in my opinion, until they form a base and do a little bit of work. If you want to be in this space, just consider buying the KRE, a regional bank ETF that looks just like the stocks, and it pays a beautiful 3.4% dividend. The next group here, and I'm not going to go very far because it's depressing. I'm going to go through REITs because at least a couple of them look good. Occidental Petroleum, dead cat bounce city on the oils. Hard for me to be very excited here. Pays a 22% dividend. So if you believe it's going to be okay and you believe it's got enough cash to pay the dividend, maybe it's for you. Not for me. EQT, I like the pattern a little more. I mean, it had a dramatic move on Friday. Look at the PMC. Really powering positive here. A kahuna from a squeeze. It's a shale producer in Pennsylvania. It's 56% off of its high. If you trust it and you believe in it, it's not a bad pattern. Pays a 1.3% dividend. It's clearly under demand. I see a lot of bottom fishing here. Now this one has moved a little bit more. Cabot Oil and Gas. Again, a kahuna, mobile breakout from a squeeze. Under normal markets, I'd probably be interested in this. It's probably worth checking on the news. ConocoPhillips is a bigger one, 4.6% dividend, but beat up like the others. Hard for me to get excited by these stocks, to be honest with you. This is what happens after big pullbacks. I'm just going to go and I want to show you the first two. J&J looks like all of them, which is another ugly move with a bounce on Friday. But AbbVie doesn't look like the rest. And AbbVie, it looks to me like it's... That's not AbbVie. There's AbbVie. AbbVie had a big move on Friday, mobile breakout, a kahuna, pocket pivot, and it pays a 5.1% dividend. I like that dividend yield. Other than that, you see a lot of things that have been laggards that bounced on Friday. Now, I do have a buy watch list. It's not very exciting, to be honest with you. I'm going to put it up for a few seconds, and then we're going to go talk about Ian's boxes. Just for those that are new, my buy watch list is just a list of stocks that I'm going to put, or I already have put, into my radar screen in TradeStation. And in radar screen, I can watch Cigar's Q signals, my signals, Morales and Catcher signals, and John Person signals on a real-time basis, looking for breakouts and reasons to get excited. Here's a list of the industry groups. And let me see if there's anything here that's so good that I have to show you. I do want to call it Fiserv. Fiserv is a specialty finance company. I've followed it for years, and every time it's had a pullback, it has had a nice run-up afterwards. It had a kahuna on Friday. It's below the 200, which is bad. It's down 17%. Unlike most of my stocks, it's got earnings per share growth higher than the multiple, does not pay a dividend, but Fiserv has usually come back strong. I'm a big believer. There's clearly interest in distance education, and there were two that I was interested in, Learn and then GSX. I showed you Centene. 10 minutes. DHT is one of a number of marine shippers that broke out. John and I spied these a couple weeks ago, a couple of kahunas. Big move up on the PMC, pays a 7.1% dividend. That suggested to us that things might be moving in China a little bit more than we thought. Exteran is an oil services company, a big move off the bottom here with a kahuna, mobile breakout from a squeeze. Under normal markets, this would excite me. It's just a dead cat bounce. We don't know how far it's going to go. And then probably the best looking chart was this guy. Again, it's not even a great looking chart. It's a new high. I haven't seen a lot of new highs, at least a new high on this list. Let's see what monthly looks like. Yep, new high. Digital Realty. This is one of those REITs where they store servers or things for cloud-based computers. Breaking out to all-time high, mobile breakout from a squeeze, Kahuna, 3% dividend. So I wish I could show you more exciting things, so let me talk about the boxes. Because in my mind, the boxes are exciting, and I've thought about making everything bigger, but then I did that and the computer shut off, and I had to do this all over again. So back to my slides. Why Ian's boxes? This is something Ian introduced us to 15 years ago or more. He basically said that the stocks that do the best off of a bottom. We are setting up a bottom here. I don't think we're there yet, but we're going to get there. The ones that behave the best are ones that have high earnings both last 2 quarters and the last 5 years. That based upon the last 2 quarters on the top, the last 5 years on the left, you can build a grid, and that box 1 doubles in 1 year, box 5 doubles in 2 years. Box 7 are typically stocks that had a difficult time and have turned around. And those are 1, 2, 5, and 7 are the boxes that usually outperform for me. Here's another way to put it if you wanted to write this down so you can make your own boxes. But if you have HGSI, don't bother. I'll show you how to do it in 2 minutes. If you look at performance, this were the boxes, 92, 93, about 5 months of time. Notice the returns 59, 40, 55, and 47 in my favorite 4 boxes over a 5-month period. It's interesting looking at this because a lot of these, if not most of the companies, aren't even here anymore. They've been acquired. 98 to 99, October through January, 3 months and 7 days. 190 stocks made the list. 67% average return, 94% box 1, 85 box 2, 70 box 5, and 102% return in box 7. Wow. What about 2010, 9/1/2010? Put the boxes together, market peaked April 29th to 11. So you had 4 months and 4 months, 8, 9 months. Looked at ERG 255, that means EPS rank, relative strength rank, and group rank together added up to 255 or more. During this period of time, the S&P was up 24%. Box 1 stocks were up 125%, box 7 106, and everything was up more than the S&P. Wouldn't you rather get a 4 or 5 times the S&P return? June 23rd, we put together the boxes the same way. Again, some things are no longer here. And here's what the boxes did. Not as exciting as the others. The S&P was up 6.8% in 2 months. We have 31% on box 4, 27 box 5, and every box group outperformed the S&P 500. Do you think now might be a good time to figure out how to create a box list? You know, earnings per share doesn't change frequently, so I just start to prepare a list, and then I might watch how these things are doing. So, how do you prepare a list in HGSI? I think I know that. So let's go into HGSI, and let's build this thing up. Let's go to all securities. And with all securities I don't want that. I want to go into default view. Don't want that either. Why am I getting a filter? 1 moment. I've got 8,878 groups. You'll notice over here there is a column of boxes. Oh, please don't shut off. Okay, good. And you can see box 10, da 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 da. What I want to do is I want to find a filter that right here. Since the market's been tough, I'm going to set the ERG down at 240. So this filter here requires ERG of 240. Price $2, 250,000 shares. Let's hit OK. So we have 189 stocks meet the criteria of ERG 240. And we have 84 of them are box stocks. Okay. Now I'm going to go to this pie-shaped thing here, spectrum analysis. I'm going to hit that, and I'm going to go to this folder in here. And no, wrong one. Sorry about that. I'm going to go to the slices, and I'm going to load custom slice options, which was already loaded. I'm going to go to Hgsi box stocks. Typically, you have to point your computer to that. App data, roaming, Hgsi version 8, user slices. All right, and it automatically puts the stocks into the slices. In fact, you can tell me what's in slice 1, slice 2, slice 3. Well, that's great, still too much work. Now I'm going to hit the file thing here, plus. I'm going to make a group. We're going to call it Jeffrey's, that's cheating, Ian's boxes as of 3.15.2020. Okay. Now I'm going to show you magic. You ready to see some magic? First, got to let it finish. I'm so excited. All right. It's magic time. I am going to look in my user groups, and I have Ian's boxes as of 3:15. And here we are, each group. That's box 1, box 10, 2, 3, 4, 5, 6, 7, 8, 9. So we've actually populated the box list. And now what I could do, just out of curiosity, see how they did on Friday. So let's go one group list I want to look at, which is Ian's boxes. Okay. I want to look at one-day performance, and I don't know if they did well or not. So today is the 15th. So this would have been closing price the 13th. Excuse me, the 12th to the closing price the 13th. Ian boxes. I wouldn't be expecting them to look special now, but I'll be watching them frequently because when I start to see these break out, that will be further evidence that we had a bottom. Okay, I did something wrong. Hold on. I know what I did wrong. Okay. So let's try this one more time. Tools, group performance analysis. So this shows you on Friday the returns, not chump change, box number, and you can look down here and take a look at what the components of the various boxes are. I would not expect these to look special yet. I expect them to look special when we've hit a bottom and the market starts to go up. On that note, have a great St. Patrick's Day. Be safe. Be careful. Wash your hands constantly with soap. Don't touch things. Stay your distance, and maybe we'll all make it through this COVID-19 in one piece. And remember, it's not about you. It's about your loved ones that are of age and of high risk because they're at risk of dying. Goodbye, everybody.